Hi, I'm Keith McCullough. Welcome back. I'm here with our Managing Director of our energy research effort, Kevin Kaiser, who's done a tremendous amount of work on MLPs and their accounting. Today he held a conference call on non-GAAP MLP accounting, which is a very interesting topic and a very well attended one at that. We had a lot of questions and interesting ones from institutional customers who were interested in Kevin's work. So, Kevin, on that, why does non-GAAP accounting matter for these MLPs?
Non-GAAP accounting is everything to these MLPs because this is the number that these management teams and sort of the whole investment community has been led to believe this is the matter. These are the numbers that everyone needs to look at. So it's numbers like EBITDA, adjusted EBITDA, maintenance capital expenditures, distributable cash flow, everything that quote unquote matters today to master limited partnerships is non-GAAP. So I thought this was a really interesting and important call to host with Julie Hilt-Hannock of CFRA Research. They're a forensic accounting firm, and it was a great call, and she had a lot of great things to say about MLP non-GAAP. Very informative.
Now, she was like, I've heard a lot of feedback already from our institutional customers on this, that she was very informative. But secondly, she didn't make any definitive statements about how the SEC might think about MLP accounting, right. But she did enlighten people, it sounds like. What did you learn specifically?
Yeah, I mean, neither Julie nor I know what the SEC will or won't do. Nobody knows what the SEC will or won't do. Only the SEC knows that. But she highlighted a lot of key risks as to what the SEC might look at, or what would be red flags that would get the SEC's attention. We talked a lot about the SEC inquiry into Linn Energy. Mm-hmm. That is still ongoing with respect to their non-GAAP measures. Julie thinks that could be a watershed moment for the MLPs.
I mean, just setting a precedent so that these management teams actually have to go to some kind of conforming reporting.
I think what it is it's a disclosure issue. It's one thing to put out non-GAAP measures, but it's another thing to have the proper disclosure and the proper context to say this is really what these non-GAAP measures are, and this is what we mean by them. And so Linn Energy's issues, I think, are pretty endemic among MLPs. And so what the SEC decides to do with Linn Energy, I think that could reverberate throughout the entire space. Mm-hmm.
It's interesting when you say it's like endemic, because this is almost the answer. For those of you that don't know, Kevin was widely cited in the most recent Barron's cover article on Kinder Morgan. And it was almost like these endemic issues that you might have, or a lot of people might be considering, to the industry are like, well, that's the way it's always been, therefore.
Yeah, I mean, I put out arguments why I think Kinder Morgan or Linn Energy or Boardwalk Pipeline Partners and a lot of these big MLPs, I think investors should get out of these positions. And I put forward fundamental arguments. And really, the pushback I get is not so much that, hey, you're wrong on this.
It's you're wrong on your cash flow analysis.
Yeah, you're not wrong on your fundamental work here. You're not wrong on your research. It's that you're right, but people don't care. Or you're right, but it's always been this way, and it's always going to be this way going forward. I think that's a huge risk. But yeah, I mean, I hear that time and time again.
Well, that's a very interesting amount. I get to see that pushback with Kevin because I could see customers come back to us on stuff like this. But then, boom, Boardwalk Partners, basically their dividends cut by 80% and the stock's down 45%, and now people care.
Yeah, look, I mean, fundamentals don't matter until the distribution gets cut, and at that point it's too late. I mean, investors get hurt.
So to circle this back on why this matters in terms of explaining it, in terms of disclosures, isn't the basis of this, I'm trying to explain to you why this company isn't representing their actual free cash flow the way that every other company should?
Yeah, I mean, the fundamental point here is that distributable cash flow, the non-GAAP measure that is most important to MLPs, I think, in my view, MLPs put this forward as, here, this is representative of our ability to generate profits, or this is representative of our economic reality. And through my research, I just think that in many cases, that's just not the case at all. And so
they've taken great
liberties, huge liberties, huge discretion in terms of how they get from the GAAP net income number to whatever non-GAAP number they want to put out to investors. I think in those line items, in those adjustments, I think is huge hidden risk.
And on that front, like maybe just to wrap this up, I mean, we also get a lot of pushback from the retail investor community because stuff like KMP is 80% retail.
Yeah.
Now, to me, it seems, I can just tell by the line of questioning, it's not about it's always the way it's been. It's actually about I own this because it has a yield and I don't actually care or have cared to do the work. So there's a level of ignorance out there in the retail community, it seems to me, just looking at, and again, I look at Twitter for a lot of this kind of contra-stream type feedback. What do they do?
I mean, the retail investor, look, it's human nature to like or have some sort of attachment to anything that's really worked for you for a long time. Mm-hmm. And when you're thinking about stocks and you look at a stock like KMP over the last 10 or 15 years, or really, really any MLP for the last decade, it's just been straight up, right? And the returns have been phenomenal. And so mm-hmm. when I come out and say, hey, this is not what you think it is, I think the initial reaction is just sort of emotional and angry. Mm-hmm. I don't think the retail investor, really knows what's going behind that distribution. All they see is that yield, and they see that it's worked for a very long time. And anything that I'm saying that's different from what other people are saying, is offensive to them. So it's not surprising at all to me that I get this sort of pushback from the retail investor. But really, I'm sort of villainized here, but I'm trying to look out for them. It's the height of irony.
You're being humble about it. The reality is that Kevin's not being villainized with our institutional customers who are on this type of call, and institutional customers are reacting in a way that's probably predictable. As you educate people on a topic, as the topic becomes more disclosed, people start to react to it in kind, and we think that the retail investor in particular is going to follow that institutional lead. So if you have any questions on that at all, it's a hot topic. We know that it is on a variety of different fronts. Please tweet me or Kevin Kaiser. He's at Hedgeye Energy. You can find him on that Twitter handle. And I am at Keith McCullough. Thanks.